Hello everybody and welcome back to our channel Polo Vega. Ladies and gentlemen, in today's video we're going to talk about derivatives, which are an exotic asset class that play a very important role in the life of every investor and trader. But before we go on to our video, let's look at the disclaimer/disclosure clause. Disclaimer/disclosure clause. The contents of this presentation are for information purposes only. The material has been obtained or derived from sources believed to be accurate, but we do not guarantee its accuracy. The presentation is the ninth of a series of interactive videos aimed at educating our viewers about derivatives as financial securities based on various underlying assets that one can trade on various exchanges or over the counter. Derivative is a financial contract whose value is dependent on an underlying asset, group of assets, or benchmark. A derivative is set between two or more parties that can trade on an exchange or over the counter. These contracts can be used to trade any number of assets and carry their own risks. Derivatives can be used to either mitigate risk or assume risk. Derivatives can move risk from the risk averse to the risk seekers. On this slide, we're going to talk about the relationship between the risk on an underlying asset and the price of its derivative. Derivatives derive their value from the underlying asset, group of assets, or benchmark. Prices of derivatives derive from fluctuations in the underlying asset. In other words, volatility in the price of the underlying asset determines the price of the associated derivative used to hedge the risk from changes in the price of the underlying. Derivatives are usually leverage instruments which increase their potential risk and rewards. Common derivatives include future contracts, forwards, options, swaps, and CFDs. Now we're going to see that the derivatives are a zero-sum game. Unlike equities or any of the underlying assets, where it could be a win-win situation for everyone, derivatives are a zero-sum game where one of the contracting parties loses while the other one wins, or vice versa. The loss of one party is the gain of the other. They can be used for hedging, speculating, or arbitrage. In the adjacent diagram, we can see that the purpose of derivatives is either hedging, speculating, or arbitrage. Derivatives are complex type of financial securities. Traders use derivatives to access specific markets and trade different assets. Typically, derivatives are considered an advanced form of investing. The most common underlying assets for derivatives are stocks, bonds, commodities such as grains, metals, energies, etc., currencies, interest rates, and market indexes. Derivatives can be used as hedging, speculating, leveraging instruments. Derivatives can be used to hedge a position, speculate on the directional movement of an underlying asset, or give leverage to holdings. Derivatives can be traded on exchanges or over the counter. Most companies hedge to manage risk and do not speculate on the price of the commodity. The hedge is utilized to protect the profit margin built into the price of the commodity. It helps keep the trade profitable in spite of adverse market movements. Over-the-counter derivatives are subject to counterparty risk, as there are chances that the parties entering the transaction might default as the contract is unregulated. One can use currency futures or currency swaps to lock exchange rate risks. Risks that you can handle with derivatives could be one of the following or a combination of the following: commodity price risks, exchange rate risks, counterparty risks or credit risks, or interest rate risks. A very good example of hedging commodity risk can be seen on the diagram on the right hand side. Here we can see that wheat is being sold at a future price by a seller who's trying to fix his profit or hedge his profit, while the buyer is trying to fix his wheat price and thus safeguard the price of his raw materials used. There could be a wide range of derivatives, but we have some common ones. Modern day derivatives are based on a wide variety of transactions and have multiple uses. Different types of derivatives can be used for hedging, speculation, and leveraging a position. There are two classes of derivative products, lock and option. Lock products such as forwards, futures, swaps bind the respective parties from the outset to the terms of the agreement over the life of the contract. Option contracts such as stock options or ETF options offer the holder the right but not the obligation to buy or sell the underlying asset or security at a specific price on or before the option's expiry date. Definitions of various types of derivatives. Forwards are non-standardized contracts between two parties to buy/sell an asset at a future date while the price is fixed at the time of entering into the contract. They are mostly used for hedging but can be used for speculation as well. Options are contracts between two parties to buy/sell a security at a specific price. When investors buy the right to purchase an asset at a price over a specific period, they are bought a call option. When they have bought a right to sell the asset at a price over a specific period, they are bought a put option. Futures lock the buyer and the seller into a contract to buy/sell the underlying asset at a specific price on a future date. Originally, they were used by commodity traders who used to lock the prices in and hedge themselves against rise/fall in prices of the underlying asset. Nowadays, they are used to buy various financial securities. Swaps are derivatives that allow the investors to take advantage of their securities benefits. They are quite common in the interest rate derivatives market, where investors of fixed interest instrument holders can enter into a contract for exchanging interest rates with holders of instruments with variable interest rates. We hope you enjoyed our short video introducing derivatives, their types, and their use in various kinds of transactions. In our next video, we shall talk about forwards and futures as an exotic asset class for every trader and investor. If you like our video, please press the like button underneath, and to watch more, please subscribe to our channel Polo Vega. Until then, please keep saving, keep investing, and keep getting wealthier. You may also visit us at our website www.polovega.com or contact us at our Twitter handle @polovega. Thank you for watching our video and look forward to seeing you next time.